Your credit score is one of the most important numbers in your financial life. It affects everything from your ability to get a mortgage, auto loan, or credit card to the interest rates you're offered, and even things like renting an apartment or getting certain jobs. Despite its importance, most people don't fully understand how it's calculated or how to maximize it quickly. Over the years, banks and credit institutions have designed the system to favor consistent long-term credit use, which often keeps people reliant on borrowing and paying high interest rates. But there's one little-known hack that can dramatically boost your credit score faster than almost anything else. And banks typically won't tell you about it because it can cost them money. Understanding this hack and applying it correctly can completely change your financial situation, giving you access to lower interest rates, higher credit limits, and more financial freedom than you thought possible. Today, we will talk about the #1 credit score hack banks don't want you to know. So before we start, make sure to hit the like button and subscribe to my channel. The first step to using this hack effectively is understanding exactly how your credit score is calculated. Your credit score is influenced primarily by 5 factors: payment history, amounts owed, length of credit history, credit mix, and new credit inquiries. Among these, the single most influential factor is your credit utilization ratio, which is the percentage of your available credit that you are actually using at any given time. Most people overlook this, but it has a bigger immediate impact on your score than simply paying bills on time or having older accounts. High credit utilization signals to lenders that you may be overextended, which can significantly lower your score. Conversely, keeping your utilization low, even if your total debt is high, can boost your score substantially. The #1 hack that banks don't want you to know revolves around strategically managing this credit utilization. While most financial advice focuses on paying down balances over months or years, the hack is simple. Increase your available credit without taking on new debt. This can be done by requesting credit limit increases on your existing cards, opening new credit accounts strategically, or even becoming an authorized user on someone else's account with a long and healthy credit history. By increasing the total credit available to you while keeping your balances the same, your utilization ratio drops dramatically, and your score can jump within just a few billing cycles. Many people don't realize how powerful this is because it doesn't require paying off huge amounts of debt or waiting years to build credit history. Requesting a credit limit increase is often simpler than it sounds. Most banks will approve an increase if you have a history of on-time payments and responsible credit use. You don't need perfect credit, just a track record of reliability. Even a moderate increase can significantly lower your utilization percentage, which directly improves your score. Some people are hesitant to ask for more credit because they worry about being rejected or facing a hard inquiry. The truth is, many banks approve increases with a soft pull that doesn't affect your credit score, and even if a hard pull is required, the resulting score boost from lower utilization often outweighs the small temporary dip from the inquiry. Another strategic way to apply this hack is by opening new credit accounts. But you must do it carefully. Each new account increases your total available credit, which again lowers utilization. However, opening too many accounts at once can result in multiple hard inquiries, temporarily reducing your score. The key is to apply selectively, spacing new accounts over time, and choosing accounts that offer long-term benefits like low or zero annual fees and high credit limits. Adding a credit card with a low interest rate or a rewards program can provide additional value beyond just the score increase. Becoming an authorized user on a family member or friend's account with a strong credit history is another clever tactic. By adding your name to an account that is well managed, you benefit from the positive history associated with it, instantly increasing the average age of your accounts and showing additional available credit. This can create a noticeable jump in your score without you needing to use or borrow any money. Many people overlook this method because they assume it requires direct responsibility for the account, but in most cases, you don't need to touch the card or spend money to benefit from the history. Timing is also crucial when using this hack. Credit card companies report balances to credit bureaus on specific dates each month. By paying down or temporarily increasing your available credit before these reporting dates, you ensure that your utilization ratio appears favorable to credit agencies. Even a short-term change in utilization at the right time can create a measurable increase in your credit score, sometimes by tens of points in a single cycle. This makes timing and strategic payments as important as the overall strategy itself. While this hack is powerful, it is most effective when combined with consistent on-time payments. Payment history is still the largest factor in credit scoring, so keeping up with all minimum payments is essential. Late payments, collections, or missed bills can offset gains from utilization strategies. Therefore, using this hack responsibly requires discipline. Increase your available credit, maintain low balances, pay on time, and avoid taking on unnecessary debt. Additionally, monitoring your credit regularly is essential when applying this hack. Many people only check their credit score occasionally, which can make it difficult to see the immediate effects of strategic changes. By tracking your credit weekly or monthly, you can measure the impact of increased limits, authorized user additions, or new accounts and adjust your strategy as needed. Regular monitoring also helps you spot errors or inaccuracies that could be dragging your score down. Another advantage of this hack is its long-term compounding effect. Lower utilization not only boosts your current score but also helps maintain a strong credit profile over time. Lenders reward consistent, responsible use, and by keeping utilization low while maintaining on-time payments, your credit score can remain high for years. This opens the door to better interest rates, higher credit limits, and more financial flexibility, benefits that can far outweigh the short-term effort required to implement this strategy. Moreover, this hack works synergistically with other credit-building strategies. For example, keeping older accounts open, maintaining a mix of credit types, and avoiding unnecessary hard inquiries all complement utilization management to maximize your score. Many people focus on one aspect, like paying down debt, but fail to realize that combining multiple strategies amplifies the effect, resulting in faster, more substantial credit score improvement. The psychological benefits of seeing your score rise quickly are also important. Instant feedback reinforces positive financial behavior and encourages continued responsible credit management. In addition, this hack can be combined with smart budgeting strategies for maximum effect. By keeping track of spending habits and ensuring you never exceed a small portion of your available credit, you reinforce your low utilization ratio. Automating payments, setting alerts before billing cycles, and paying down balances just before reporting dates can maximize results. Even small changes, like consistently keeping balances under 10% of total credit limits, can result in dramatic score improvements over a few months. This method not only impacts your credit score quickly, but also creates lasting habits that strengthen your financial discipline over time. If you liked this video and would like to see more like it, please give it the thumbs up. Leave a comment and click the button to subscribe.